I'm really interested because it's been such a weird year. I think this is a year where stocks and bonds kind of have, like, everything's kind of gone down, right? And that hasn't happened for a long time. And I know, talking to a lot of my clients, some of them kind of go, well, it's just how it goes. It goes up, it goes down. Other people are really worried.
For those that don't know me, I'm Christina Lindsay Orta with Lindsay & Lindsay and Ascent Wealth Management. I'm currently CEO of both firms, and we've got Jim Cunningham of CunninghamLegal, and he owns CunninghamLegal. And we've also got Philip Blancato with us, who is going to give us our economic update today. Phil and I are longtime friends, but Phil runs Ladenburg Thalmann Asset Management and helps oversee probably about a few $100 million of our clients' assets with us, and really has been a great partner, as well as someone that I think can speak fairly layman terms on giving us an update on the economy and viewpoints. So that's what we're here for today, is to have Phil enlighten us.
Thank you for having me on. It's exciting to be back with you. I can jump right in, but Jim, did you have anything you want to kick us off with?
No, I'm really interested because it's been such a weird year. I think this is a year where stocks and bonds kind of have, like, everything's kind of gone down, right? And that hasn't happened for a long time. And I know, talking to a lot of my clients, some of them kind of go, well, it's just how it goes. It goes up, it goes down. Other people are really worried, and they're really scared because, you know, you got your nest egg and you see it going down. And I actually did look at my statement, my year-to-date loss. It was like, wow, that's a big number. So yeah. I think it's on a lot of people's minds. It's weighing heavy on people's minds. And I think a lot of people, frankly, are scared. So I don't mean to be like Johnny Raincloud, but that's just the way it is. So,
but maybe you give me my prelude to my opening comment.
All right.
There you go. Don't panic.
Good.
Before. Truly, we have been here before. You're right, Jim. I mean, something you said is critical. I think everyone, when you think about this year, it's simply the worst year in your investing lifetime. There's no other way to put it. 2008, no big deal. We knew we had a pretty good idea what was happening. We knew how recoveries worked, and it worked out just fine. The tech bubble of 2001, if you were active in your portfolio management style, you did just fine. It took 13 years for the stocks to recover on the tech side, but value stocks did quite well. You think about 2015, a year that oil imploded. 2016 completely rebounded. 2018, the last time we had a similar event, Jerome Powell, and I'll never forget this, with very aggressive comments, and that's the last time the Federal Reserve hiked rates, in the December meeting, sent the market into a tailspin. Literally, this is deja vu. And I'm Italian. My mom and dad are from Italy, and we have a really big Christmas Eve feast every year. It's all fish, and I'm in charge of the garlic clams and the fried calamari. And I jokingly say I burnt the calamari that year because the market was only open for a half day and went down 3% on Christmas Eve that year because of the comments made by the chairman. And not unlike yesterday's comments, which were more difficult than expected. So this year, what's so challenging is, to your point you made, actually, you've never in your lifetime had the bond market down double digits, nearly at its worst, 17, almost 18%. And the stock market at one point down almost 27%. And that's because of so many things of the last 40 years have now come together at the same time. Decades of interest rates going down, and we can get into the reason why rates have gone down, but also a decade and a half of stock market going up. Eventually, these things normalize. And that's what this year really is about. It's a process of the normalization of the markets, meaning the boom years after the pandemic. Notice I didn't mention the pandemic, because even though the stock market cratered in 2020, it fully rebounded and gave us a 28% year. So these imbalances have been created by the involvement of the federal government. Federal government in and of themselves, specifically the Federal Reserve, has been extremely active in markets for really since 2001, but more so in 2008, and very much so in the last few years. And that's why we've had this whipsawing of a year here. But it is a process of going back to normal. And that's what I want to talk a lot about today. That I know this year's painful, and I know you're seeing your accounts down probably double digits. If you're in just a bond portfolio, you're down, anywhere from 10 to 15%. I would argue it's the best investing opportunity of your lifetime in the municipal bonds. We haven't had an opportunity like this in municipal bonds again in decades. So there's always opportunity when there's an obstacle in the market. These obstacles that have been put in front of us, yes, they are obstacles. And to surmount them, we've got to let the passage of time go by. But an obstacle in the bond market means a chance to finally earn yield again. An obstacle in the equity market means a chance to finally buy stocks that are cheaper. An obstacle in volatility means you're active in your portfolio and you do things to lose less when markets are down. So your point's spot on, Jim. Thank you for the lead-in. But to be honest with you, this process of normalization, going back to normal rates of return, I think was what we had to go through here. And on the other side, I think we'll be just fine. Let me show some slides. Let me get us some slides, and maybe I can graphically give you some things that I think are really important to understand how we got here and where we're going. Okay, hopefully you can see that. You get that big screen in front of you there. It says Market Insights for 2023, right? We got that?
Yep.
Excellent. Perfect. Why don't I let the guys from Ascent, Christina, you want to talk about everybody that's on here a little bit?
Yeah, I just want to make sure everyone just knows that we've got a team of 4 CFPs. So this is our entire team. We didn't want to have everyone on here today, but this is our entire team. So
I know them all very well. They're all good friends. That guy on the right's my buddy. So I've known John for a long time and had the benefit of working with your whole team for a long time. They're some of the most qualified people I've ever known. So kudos to you all who work with them. You're very lucky to have such a strong team.
Thank you.
Jim, I'll hand this one off to you, buddy.
That's our crew. That's our lawyers. We've got a great background in lawyers. We're licensed in multiple states. Diego there on the lower right-hand corner is licensed in Mexico. So he is originally from Mexico City. So that's come in very helpful with many of our clients. So we help people out. A lot of tax mitigation strategies, a lot of, mom and pop kind of normal estate planning. And frankly, a lot of people who have kind of larger, more complex estates that need continual care and feeding, right, from their lawyers. So that's, we kind of handle the spectrum of the estate trust and tax planning. So that's us.
I've gotten the benefit of working with both of them. And for those of you who are using the power of the two combinations, it's incredible how much they've been able to mitigate cost, tax, and still drive performance. In a world where taxes matter more so than maybe ever, I think you're very lucky to have this kind of team behind you. Okay, I'm going to jump in here, and just a couple of things I'd like to point out to frame the conversation. So I'll start with the right and then I'll work back to my left. On the bottom right is an example where we started. I'll use Jim as my example again. Jim hit on something really important. When you look really at the last 100 years since I wrote this chart, this is the worst year for a 60-40 portfolio ever. And most of you are probably in some version of 60-40. Nobody ever really wants to be very aggressive or ultra conservative. The bulk of investors end up square in the middle of 60% in stock and 40% in bonds. So you can see throughout history, there's been a couple tough years, but the last time we had anything even remotely this difficult was all the way back to just about 1928. And the reason why is we've lived in a period of time when the bond market over the last 40 years has made us money. If you remember back to the Ronald Reagan days and the Jimmy Carter presidency, remember there was a few things that caused inflation to skyrocket. It was wages, crushing oil, and the burden of very heavy regulation. All those put tremendous pressure on the U.S. economy. Unions won the day, pushing costs exceptionally higher. It's how the United States has changed its structure around unions because of some of that to a degree. But more importantly, we saw inflation going to the highest ever in the United States. Even this bout of inflation wasn't as high as inflation then. Close, very, very close, but not quite there yet. The federal funds rate at that time went all the way to 12%, pushing the 10-year U.S. Treasury to 15%, the 20-year U.S. Treasury to over 20%. So you're getting yields of your bonds. If you went to the local bank, you might remember this. I joked, you used to get a toaster when you opened the account if you gave them cash. Now they take your toaster away because they don't make as much money on you. But it was starting to look a little bit like that from way back when, because back then we spent the last 7 years now making no money on cash. Back then you could get, believe it or not, as much as 7 or 8% on just your cash at a bank. You could buy a CD earning 15, 20%. Well, here's how this works. Over the last 40 years, as the economy became more efficient, as costs were driven down, as deflation in the form of goods, this shirt, that I'm wearing today, I have a Christmas party tonight, so I'm a bit casual this time, forgive me. When you think about much of the goods in your lifetime, they haven't accelerated nearly as much as we grew up with. So think about buying a car today or buying a washing machine. Yeah, they're more expensive than they were 40 years ago, but not significantly more expensive. Not 10 times more expensive, maybe 2 or 3 more times. Why? We imported deflation. We imported cheaper goods from other places in the world instead of making it here. That's a whole conversation around the U.S. middle class. That's for the next call. Point is, as interest rates, as the US economy moderated and slowed, and as inflation went down over time, so did interest rates. So over a 40-year period, interest rates have gone from 20% on the 10 US Treasury, 15%, 10%, all the way down to where they were at the beginning of this cycle, which was basically at the bottom 0.3. So imagine for a minute, if you gave the federal government money for 10 years, they would only give you like 0.3 per year. That's how low the 10 US Treasury got. So what happened? We had to normalize. We had to go from 0.3, which is far too low on interest rates, but not back to 15. So where is it settling in? Right now, we're at about 3.5%. That movement higher in interest rates is why the market has gone so much in bonds. So the bond prices have an inverse relationship. As interest rates go down, existing bond prices go higher. As interest rates go up, existing bond prices go lower. And here's why. Let's say Christina owned a bank, and I bought a CD from her 6 months ago, and she gave me a 2% yield on my 6-month CD. And then I went into her bank today, and she said, hey, I can give you 4% on a 6-month CD. Are you interested? And I said, sure. What's a better CD? The CD I bought 6 months ago, or the CD I bought now? Well, the one I'm buying now, right? So what happens to the one that's 6 months ago? Well, it's got to go down in price to justify buying it versus the one that's coming out today versus at 4%. So what happens? Instead of buying it at 100, I got to buy it at 80 to make up for the 2% I'm not earning. So the price goes down, pushing the yield higher. That's why bond prices with money. It's an inverse relationship. Really very straightforward. What happened this year? Interest rates went from basically 0 to 4.5% as of yesterday. So that movement higher punished the bond market. It still is. The bond market down the worst in decades. Now, as a money manager working with the two of them, what do? We loaded up on bonds that actually make money as interest rates go higher. We made the bulk of the portfolio being very short-term yielding bonds that mature in less than 3 years. We did that so we feel less pain. Bonds have acted like insurance in your portfolio for years. Right now, they're actually not doing that at all, but at least we as an active manager have limited the amount of loss we have there because of what happened in the interest rate cycle and the change. So that's why the 60-40 portfolios got beaten up. The stock market, that's an easy one. The reason why the stock market went down is because it got expensive. Inflation has a little bit to do with things as companies grow every single year. If they have to spend more on the cost of goods, whether it's in people or wages or stuff they buy, because inflation is running higher, well, then they make less profit. But inflation is a relatively new issue for corporations. It's really just this year. And we look at corporations' earnings over a period of time. Really what's happened is the stock market got far ahead of itself. The price of stocks, like Tesla, had gotten so expensive, they had to come back to earth. In 2021, stock market earnings were 41%, meaning if you ran a company, you made an increase of over 40% in 1 year on average in 2021. This year, it's going to be something to the tune of 5. So going from 40 to 5, well, the stock price has to drop because if you're earning less money, then your stock is worth less. That's why the stock market corrected. So that terrible red line there represents 2 very bad things happening at once. The U.S. economy slowing and going back to normal, hurting stock prices, less about inflation. Inflation a little bit to do it, but not a heck of a lot. And the bond market, after 40 years of making money, having to give some of it back. That's how we got here. That's why it's been so tough. Now, interestingly, the chart on the left, when you look at the S&P 500, traditionally, bonds have been an absolute win. Every time the stock market went down in terrible moments, what did the bond market do? It went up. And that's what's different. This time, bonds did not act like a counterbalance to stocks. And that's why it's been arguably the worst year of your investment lifetime. Doesn't mean you can't have opportunity, though. What do you do in times of volatility? We own big dividend stocks. Why? If my portfolio is earning income, well, then I smooth out some of the losses because I'm getting paid to wait around. I'm earning income as I'm being paid to wait around. My bond portfolio, if I'm willing to keep it because it can bring some safety because bonds mature like a CD does. But as long as I reduce some of the risk of them by owning shorter term bonds and some bonds that actually go up with the rate of interest rates, well, I'll lose some money, but not as much. And that's the trick. You still take advantage of it. What are we doing now? Well, we own big dividend stocks to keep waiting for the stock market to normalize. As a day like today tells you, we're not quite there yet. But in your bond portfolio, what are we going to do pretty soon? Well, we think interest rates are going to go back down. Why? Because inflation's starting to correct. We're seeing inflation begin to roll over and go back down. Well, the inverse happens again. As interest rates go back down, then the prices of bonds go up. So all the money we lost this year, we might get a big chunk of it back next year. The expectations are that the 10-year US Treasury right now at 3.5% will be at 2.25 by the end of 2023, and more along the lines of 2% by mid-2024. So what are we going to do? Switch from short bonds that are less price sensitive to longer bonds that are more price sensitive. So some of that money we gave up this year, we'll get back as interest rates go back down. Why are interest rates going back down? Because inflation has always been transitory. The transition period can be maybe more than a month. In this case, it's probably more likely 2 years. But the transition is about efficiency. Think about how more efficient the U.S. economy is today because of all we get out of our iPhone. This communication. Let's use this as an example. I'm speaking to all you folks online today. You didn't get in a car, you didn't use any gasoline, you didn't drive around, you didn't stop at the Starbucks or whatever and get yourself a coffee. You didn't spend any money whatsoever. We're going online, it's free cost to all of us. We have a fee, we pay for the service, but that's about it. Think of all the money in the economy that didn't get generated by us having a Zoom call. I didn't jump on a plane. I didn't go out there and buy a hotel room. None of that stuff happened. So that's the efficiencies we now bring in the system. That's called deflation. Less cost, higher productivity, more money. So in the long term, inflation goes down, not up, but it's a matter of how can we take advantage of it in times like this. A lot on the first two slides, but I'm going to go a little faster. A couple fun tidbits of history here that I think will be helpful for you. By the way, there is a spot on the bottom here where you can ask a question. So if you have a question, you can type it in the Q&A box and I will gladly answer the question. First one.
I just want to mention one thing. The slide before, I think that on the left-hand side in the 1920s, I think that was 1929, if I'm looking at it.
What did I say?
You said
28.
28.
Oh.
But this year is worse than the big stock market crash of 1929 when you look at the 60-40 portfolio, right?
Or 60-40 portfolios, yeah.
Right.
And what I want to clarify here, and Phil and I have talked a lot about this, is a lot of times investors are reactionary. And so just because you see this, you might go, gosh, I don't want to touch 60-40 with a 10-foot pole. But at the same time, 60-40 is a great place to be right now because bonds are finally acting like bonds. So just because what didn't work this last year doesn't mean that that's not going to work going forward. I think 60-40 is back because true diversification is going to actually act like diversification. If you have bonds in a higher interest rate environment where the pain in the bond market has already been felt, to Phil's point, all the value of those bond funds has already been hit in the market. So just because it didn't work this past year doesn't mean that it won't work going forward. And I want to be clear on that.
And to Christina's point, look at the average rate of return. Throughout history, going back to, I think it's 1925, this chart tells you that the average rate of return of a balanced 60-40 portfolio was 9%. Well, that's darn good. That's far above the average rate of inflation of 4%. And that's why we do it, because it's the least risky of the portfolio with a very high average rate of return. That's why the 60-40 portfolio is so popular. Okay, I did have a really good question. I want to answer real quick. Anita, thank you for the question, Anita. Is 23% reduction in portfolio normal for this transition time? 23% meant you were predominantly in stocks, and that meant you probably were predominantly in tech stocks. If you look at value stocks, they were only down at their worst about 13 to 18%, depending on the size of the value stock you own, and now only down about 5% on the year. So you were in growth-oriented companies, which is okay. Hopefully the reason why you're in those kind of growth companies is because you have a long-term investment horizon. Growth companies are the future of the United States. It's what's gotten us to have the strongest economy in the world in the last 20 years. But they're also the ones that are most susceptible when interest rates rise. And the reason why? Growth companies rely on future growth to become bigger and bigger, and they borrow a lot of money to do that. When interest rates push higher, it means the cost of borrowing goes higher, their earnings go lower, less potential for growth. So in rising rate environments, they tend to get hurt the most. But you know when they perform the best? When environments go back to normal and we get modest growth higher coming out of a recession. So growth stocks are finally really inexpensive and they're starting to look like the right opportunity. Just not yet. Let's wait till the Fed is totally done and you'll see us add back.
And that would be like your Google, Amazon, large cap NASDAQ stocks. So the NASDAQ index, which has been the most hit this year, down over 20%, as much as 30% at one point this year, still down over 20% year to date, I believe. And so the NASDAQ stocks, highest reward on a 3-year average still. If you were to even factor in this year's decline of 20%, it's still the highest 3-year average sector. But so highest risk, highest reward. But to Phil's point, we don't want to necessarily buy more of them yet, but we also don't want to get rid of those that are good long-term holds either.
Ron, that's a good question. Do I have anything more recent? And then this chart on the left here. So Ron, I do not have anything more recent because we haven't had a market correction since then. This year would be the only year we've had a market correction since 2018. And then this would be the 1 year, i.e. the right side, where stocks and bonds are losing together, which is kind of the total point. You normally don't have a scenario where stocks and bonds lose at the same time. In fact, in your lifetime, well, the last 40 years, you've never had a bond market where we lost back-to-back years. Never anything to this depth. So not only do we never get back-to-back years of losing, it's usually you lose 2 or 3% at most. This is profound how much you lost. That's why the chart's not updated. Actually, it is updated. If you look at the 2022 in the blue column on the right, the very top of it, there hasn't been a negative year since 2018. That's why there's another chart to show you. Hope that answers your question. It's kind of an odd way to answer it, but I hope that helped it work for you. Okay, let me keep cruising through here. And please, the questions are great. All right, so I think we're going to have a very narrow recession, a very mild recession, a soft landing. And the reason why, or no recession at all, depends on what you define as a recession. I would argue we're not even going to have a recession. Because to me, a recession means you have significantly higher unemployment. And that's not the case right now. And there is some minor weakening of the labor force, but nothing to the, you got to remember this, if I'm 55. You might remember the 70s recession, the high levels of unemployment, the early 80s, the 2000 tech bubble, even 2008, significantly higher unemployment, 6, 7, 8%. We're nowhere near that. We're at the lowest in decades. So it's interesting. You can have a bear market in stocks and still not have a recession. And some of these you might remember. I don't want to take you all the way back to 1935, but look at the top. In September of 2018, that last chart, remember I showed there was an ugly market there. We were down 20% in stocks with no recession. 2011, 22%, no recession. 1998, no recession. So it's not out of the question to see this. Now, bear markets last generally around 11 to 12 months. We're already in that time period right now. We're just in the 11th month. Bear markets usually have a decline of 25 to 30%. Well, we've hit that number already. So bear markets were already historically right in the normal length of time. And after bear markets, what happens? Well, we get exceptional bull markets that can last, as usually on average, 4 years with the average rate of return of 114%. And in fact, if you look at history, anytime we've had a very negative year in the stock markets, it's usually followed by a profound positive year. So in any year when we've had the S&P fall into a bear market by more than 20%, 1 month later after the bear market ends, we're up 2.9, 3 months, 5.7, 1 year later, 24%. Put simply, look at my column on the right here. So these are bear markets and the average rate of return 1 year later. Notice whenever we've had markets where we lost more than 20%, 1957, 31, 62, 26, and so on. There were only 2 where we lost money even after the bear market ended a year later, 1973 and 2008. So we've had these exceptional returns at the ends of bear market in almost every single time period, not all, but most. So again, history being on your side, when you have a loss of 20% on average, the next year almost always is positive. So a chance to really use history as a guide. Some other fun stats on history, by the way. The best year of the presidential term is the 3rd year, the year we're about to enter. The best quarter for the markets is generally the 4th quarter. This one has been good up until today, the last few days. But I'm not convinced this year's done just yet. We can get into the Fed at the end of the conversation here. And then more importantly, when you look at every time the Federal Reserve has raised interest rates, once they start hiking, 12 months later, the market's always been positive. And even just for more fun, anytime the Fed has stopped hiking, every single time in history when we had an interest rate rise, whenever they stopped hiking, 6 months later, the average return of the S&P 500 is 15%. So we've got all this historical data that says this is the worst of it right now and a lot better stuff to come on the other side because markets have become fairly valued. So the reason why I don't think we fall into a deep recession is the labor market. So what's different this time, and I hate using that phrase, I know it can be one that spooks us a bit, is that normally the Federal Reserve is raising interest rates to cool down the U.S. economy. So they push rates higher, and it does that because it makes things more expensive. And usually the economy is very hot with very low levels of unemployment and very high earnings and growth. We don't have that this time. This time we have very low levels of unemployment. We have very muted US growth and very muted corporate growth as of late. Not negative, but just not exceptional. That's what's different this time. And the reason why I don't think we fall into a recession is with 70% of the US economy driven by the consumer. As long as the consumer stays gainfully employed, and if you look at the number up there, right, you see it right there, we were at 14.7% unemployment in 2020 during the height of the pandemic. Now we're at 3.7, near the historical low of all time of 3.5. This past November, we added 263,000 jobs, 23 straight months of over 260,000 jobs. So we're looking at a scenario where the US consumer is extremely healthy. They've gotten a wage increase of over 5 to 15% in the last 2 years. Wages are not inflationary. I could talk about that in a minute. They are temporarily, but not over the long term. We still have $1.4 trillion in cash savings from the pandemic. That money is boosting up the economy. Now we'll run out of that money by September of next year. If inflation hasn't broken by then, and the Federal Reserve is not done hiking rates, we could have a very deep recession. It's my expectation because we're seeing the beginnings of inflation come down. Look at the housing market, look at you paying for gasoline, food prices have moderated, shelter specifically rents have moderated, used car prices are coming down significantly. These things are telling us that the trend is now down. That's why inflation peaked at 10%, is now down to 7%. So we're seeing that trend happen. That means by September, when the average consumer runs out of cash from the pandemic, the Federal Reserve should be done hiking rates. In fact, maybe cutting by then, and interest rates will already have come back down to earth or falling. That should prevent a really deep and wide recession, very, very mild one that you may not even notice. And it's because of the strength of the US consumer that I don't think we fall into a recession. We got questions. I love it. I love the questions. First one from Anita. Some projections seem to project higher unemployment coming in the next 12 months. That's a great question. The Federal Reserve Chairman just yesterday says he wants to see the unemployment market get to 4.4%. So I'm going to walk you through some math here, which I think is really important. We have a demographic issue in the United States. We only have 3 to 4 million people looking for work, and there's 10 million jobs open in the marketplace. For every one person looking, there's 1.7 jobs open. So there's a shortage of bodies right now. That's what's keeping wages elevated. What the Federal Reserve wants to do is eliminate that. Let wages go back to 2% average annual growth. So if there's 10 million jobs open, and call it simple, 4 million people looking, we got to first eliminate 6 million jobs that are open. Now that's a little bit tough one because some of those are folks who work in a hotel and some of them work in a factory and some work in a white collar job. It's a mix, but you got to reduce that number quite significantly. But for math's sake, let's just say we get rid of 6 million there. But that means the unemployment rate would not have changed. We'd still be at 3.7%. To get the number from 3.7% to a higher number, to Anita's point, you'd have to eliminate at least another 1.5 million jobs to get it to 4.4. There's 163 million people working in the United States. To get it to eliminate another 1.4 million would get you to 4.4% unemployment. So that means effectively, we'd have to eliminate around 7.5 million jobs to get that number higher. I just don't see it happen. We don't have enough bodies as it is. We need an active immigration policy. We need a way to get folks here to help us fill in those 5 jobs. We have 11,500 people retiring every single day. The Gen Z, millennial generation is not yet filling that gap. Some of the folks have not yet come in from the pandemic. They might. But we've got much more of a labor shortage than we do. And that's why I don't think we have recession. And I don't agree with the expectations. I do think the number of open jobs will come down. By the way, if you want to keep an eye on this, if you want to do what I do for a living a little bit, watch temporary workers. Temporary workers are the first folks to let go. And so far, we're seeing an increase in temporary workers, not a decrease. And you can watch the month-over-month unemployment number. That's an easy way to do it. But my point is, if we don't have enough workers, I don't think we fall into recession because we have people going to stay gainfully employed. If we get real pressure and earnings really fall down and companies start laying people off, that'd be a different scenario. But have you noticed all those help wanted signs are still everywhere? Most major corporations are saying they would rather make less money than lay people off and have to hire them back on a higher wage down the road. And that's
Phil, you're also, when you say that the Fed's goal is to eliminate 7 million jobs, that just sounds incredibly cruel.
It does sound cruel. And I don't think
it's like,
right.
You're going to put, I mean, it just, the whole thing to me is there has to be another way. And this is just me speaking as a human. It just sounds cruel to.
Well, I would agree with you that most of the pain is felt by borrowers, and the borrowers are generally people with less than $100,000 a year. Let's play a fun game. Let's say Jim owns a bank. He owns Bank A, and Christina owns a bank. She owns Bank B. Here's what, and maybe you don't know how this works. I want to quickly explain it to you. When the Federal Reserve raises interest rates, here's what happens. When interest rates are zero, Jim can borrow from the federal government or Christina for zero, and he can loan it out to some borrower, someone buying a house or a car or a credit card, for whatever price he wants to make money. It could be 2%, 3%. He makes that for his own bank. All right, so Federal Reserve starts hiking interest rates. Every time they hike rates, Jim has to now pay to borrow money from Christina. So Jim runs a bank. He doesn't have cash. He goes to Christina. He says, hey, I want to borrow some money from you. He goes, oh, she says, okay. The current federal funds rate is 4.5%. I'm going to charge you 4.5% to borrow money. Jim says, fine. He borrows that money from Christina. Then he puts an additional 3% on top of it for himself. That's how mortgages make their way to 7%. Jim makes 3, Christina makes 4 because she's got lots of cash. That's why banks want you to put their deposits with them, because the more cash they have, the more they can lend out, the more money they make. Jim could also go to the federal government and borrow directly from the federal government for about the same rate, right around 4%. So what happens? Every time they raise the federal funds rate, the cost of borrowing goes higher. So, I mean, if you go get a mortgage today, it's 7%. If you got it a year ago, what was it? Probably 3. That's the 3% Jim made. Your credit card debt went from probably 13, 14 back up to 18, 19. Your car loans went from 0 to probably 4 or 5. Your floating rate mortgage or your home equity loan all increased. That's pushing interest rates higher. So now if it costs you more to buy a mortgage, what does that mean? You have less money to spend on going to a restaurant or going on a plane. So every time they hike interest rates, it makes things more expensive and it slows down demand. We buy less stuff, we do less stuff because the cost of living goes higher. And to Jim's point, who gets punished the most? The folks who need to borrow money. Who are generally those people? People who make less than $100,000 a year. Who gets really punished in environments like this? High inflation is punishing, but here's the little dirty secret about high inflation. The average family is spending $6,000 more per year to live. Let's say the average family only made $50,000 a year. People under $75,000 in income got a wage increase of 10 to 15% because they probably worked in a service job. That means they got an increase of probably anywhere around $5,000 a year or more. So they made enough money to spend the bulk of inflation, not completely. They're probably still living paycheck to paycheck, but they didn't get crushed by inflation this time. But by raising interest rates, they may just get clobbered because now you've made it inflationary and made it more expensive to borrow. So it's an interesting point.
Can I ask you a question on you mentioned the mortgage. So if I'm a bank and I borrow at 4.5 on the federal funds rate, and then I lend out, I tack on 3 and lend out on a mortgage, when that debtor makes a payment to me, where does that 4.5% I have to pay back to the Fed, right? As the bank.
Right. Exactly.
Where does that money go?
Into the government's coffers or the bank that you borrowed from the coffers. That's profit.
So that goes back to the US Treasury?
But then they turn around and lend it out in the form of bonds. So they're paying interest on our debt. Now we're going to a level deeper, but so don't forget, on one hand, they're lending it to you, but on the other hand, they got to go into the market and borrow from somebody else because they don't have their own money, right? They have money at the Federal Reserve, but we're not going to go into that. That's
Okay.
So if I got to go into the bond market and issue a 10-year US Treasury at 3.5, they're doing that because they're loaning it to give it to you at 4.
So Phil, I know you've got some good slides. I'm going to have you kind of go through a few because I know that we want to make sure we do have time for questions. And I know that
I won't shut up so far today. I'm having fun.
No, I know that we could let Phil talk for 2 hours if you let him. So
it's so terrible. There's more good questions. I'm going to answer both really fast. How much current market inflation is related to our current political situation in Washington? And do you see the change from administration? You know, believe it or not, folks, I'm apolitical. I don't pick sides. I just have to make you all money based on what they do. I do think this current administration has a negative stance on energy. And now while energy is back down quite a bit, specifically oil, that is inflationary. So I would argue that has an inflationary aspect to it. They haven't spent as much as prior administrations, so that hasn't been inflationary. But certainly some of the posturing around oil is. So the spending is reined in a bit and get reined in more as we have by the way, what does the stock market like the most? A split House and Senate. Why? Because no new spending happens. No new big tax changes happen. So that's good for markets. Outside of the energy policy, I would argue the rest isn't terribly inflationary. What is determined to be, but hold on, let me caveat that. The Federal Reserve, the prior administration and this administration spent too much. There was too many rounds of stimulus issued, and that's what caused this. You had tremendous amount of money and not a lot of goods to buy. Lots of demand and a little bit of supply, and we skyrocketed. That's how we got here. All right, last question. Anita again. Thank you, Anita. What is determined to be a good percentage of unemployment? Generally, is there such a good thing? The average rate of unemployment in the United States is 6%. Anything below that is good. And right now, it's 3.7 is fantastic. All right, so I talked about jobs. I can skip past that. This is a little bit on consumers, so I can go through this quickly. Look at the number of folks who are traveling. TSA saw 2.5 million people on November 27th. That's a pretty incredible number. 2.5 million people on July 1st. So we're seeing these numbers really increase significantly. You look down here on the right, the number of folks traveling, enjoying themselves is really pushing higher. Per person's plan, look at this on the left here, and I'll talk about this really quickly. The average per person spending on gifts for the last 10 years is $826. This year it's $832. People have extra cash. Halloween was a $10 billion, almost an $11 billion holiday, most ever. Thanksgiving, Black Friday, $13 billion, the most ever. Look at this number over here. November, December will grow to from between 6.8% or $960 billion will spend in total during the holiday season, eclipsing last year of $889 billion. Does that sound like a recession to you? When's the last time you went to a restaurant or flew on a plane or went to a hotel or did something fun? Packed. The U.S. consumer is not stressed yet. If this inflation thing doesn't go away by next year, specifically September, that's a different ballgame. But my expectation is it goes away. So the Federal Reserve, when we talk about the this is the fastest height raking cycle that we've ever seen. This 3% is a little old now. It's actually up here at 4.25%, all the way up there. Sorry, I got to update this slide. In December, yesterday, we did hike another half of 1%. But here's the irony. I'm not sure why the market was so upset. We hiked 4 times at 0.75, and we finally reduced it yesterday by 0.5. The reason why the market got upset was simply because the chairman said, we're not done yet. We got a long way to go. When I had argued, they're well on their way to being done. They're going to hike probably one more time of half of 1% in February, if not 0.25, one more time in March of 0.25, and that's it. Why? Because you're seeing inflation come down across the board. They're getting exactly what they want. And I think they are going to get a soft landing. If they get out of the way by March, inflation continues to come back down, the consumer hangs in there, we'll go to a very slow, mild growth environment. But it is the Federal Reserve that has caused so much pain as of late, and they are quickly getting out of the way. But to the point I made earlier about the municipal bond market, look at the yields you're getting here on the bond market today. We haven't seen these yields in a long time. So the red is 2021. You were getting 1.9% in 2021 on a 30-year U.S. Treasury. Now at 3.78, 152 on a 10-year, 376. Look at the 2-year. You were getting 0.73. Now you're getting a whopping 4.15. You can actually make money again in that balanced account. So not only will it provide insurance going forward, but it'll give you return. And that's the beauty of this. That's the opportunity where there once was an obstacle. So for years to come, I have high expectations. Look at my second bullet point on the left. At the end of October 2008, yield on the investment grade bonds, corporate bonds, was 9.35%, a record, 23%, excuse me. Over the next 10 years, bonds earned a whopping 8.1%. Where are we right now on corporate bonds? Just about right there. We expect the Fed funds rate to stay between 4.25%, 4.50 through the end of that period of time. That means annual returns should be around 4.75% or higher. If interest rates go down a little bit, we'll get back to that around 8% rate of return. Back to that analogy of inverse. So not only going to get a yield of around 4 to 5%, if interest rates start to go down a little bit, prices go higher, and you'll get that whopping 8%, just like we did in 2008. History is my number one starting point as a money manager. History tells me we have a huge opportunity here, and that's why I'm excited about where we're going in markets. Okay.
And that's where we will say, just on the bonds, we've been, for anyone on the call too, we've been, as people have idle cash, now's not the time to sit in cash, but it is the time to take advantage of municipal bonds, especially in California. I mean, we haven't been able to get clients 4.5% insured California municipal bonds in years. And so now's a great time if you can get above 4 double tax free versus 4 on a 2-year treasury that you're not going to be able to replace with a high income after those 2 years expire. We'd much rather get someone, a call protection that's call protected for the next 8 years or so, that you're locking in that 4 or higher double tax free. So that's really where, as people have cash, we are buyers of California bonds right now.
Absolutely. Best time in a long, long time to get really exciting tax-free yields. One last point. Remember all that talk about shifts off the coast of California? Guess what? It's gone. A really interesting article talking about how capitalism works, about many of the producers, people who bring stuff in, are no longer going to use California. They're going to use Georgia and New Jersey. Why? Because those ports never shut down. They're cheaper and more efficient. So California got themselves into a tough spot here by being less efficient and less accommodative. You're going to see probably 30% of ships go from California to the East Coast because there's now 2 canals and can get there faster. Anyway, my point is the supply chain is fixed. We do not have a supply issue anymore. Certain industries in certain places, but 98% of it is no longer. You go to stores, you're seeing an excess of things. By the way, deflationary. Extra stuff. You notice you see lots of sales when you go to Target or wherever you go. Starts coming down significantly. Why? Because there's so much extra stuff. Wait until January. You want bargains? Watch the bargains hit the shelves in January. They're going to want to unload inventory, and that's very deep. That's not inflation. That's deflation. So we went from having a lot of money and not enough stuff to buy. Now you've got decent money and a whole lot of stuff to buy. That's the transition to deflation. Nationwide, you're seeing a big issue in inflation was rents. Rents double, in some cases up 25, 30%. Home prices up 20, 30%. Home sales are down 40% year over year. Rents are beginning to roll over. We look at Redfin data, which is much more current than what the federal government looks like. So we're seeing bidding wars already reduce, and we're seeing the cost of rents come down by anywhere from 10 to 20%. And you've seen the price of gasoline, maybe not in California, but I paid $2.99 just this morning for a gallon of unleaded gas. Sorry, folks, I live in Jersey.
Don't rub it in. We're still double that.
Yeah,
At least.
I paid $4.05 for regular today.
Wow. See, there you go. That's not bad. You have $1.06 above me. As I mentioned already, a lot of history. Fourth quarter is the best quarter of the year. By the way, generally we'll see good returns by in that second quarter as well. And I have high optimism that we'll begin to recover into that second quarter and really rally into the end of the year. So that's a lot to cover. One last thing, one last fun point. So there's so much made today about the Federal Reserve and the comments made yesterday and all that stuff. Well, they're getting what they want. That was the one thing I was disappointed in what the chairman said yesterday. He did mention some things that were coming down, but I give you a good example of how higher prices are beginning to hurt the consumer, not getting them out of the way. I talked about how much we're going to spend, but certainly we're seeing pain. Today, we look at something called retail sales, and I'm shocked the market didn't care about this. Retail sales hit the lowest month over month that any time in the last year. That we had a very bad month over the summer. This was actually worse than the summer, but it's actually the worst since 2021, and just after the pandemic ended. So people month over month spent 0.6% less. I know it doesn't sound like a lot, but we went from month over month to spending more and more and more because things have gotten more expensive. It's the first time they're spending less. So the Federal Reserve is getting what they want. Soon they get out of the way. Once they're out of the way, folks, we go back to making money again. I'll stop there and see what questions we have.
Phil,
So
I have
Jim,
a
I'm going to
question.
throw one at you. I just know that, one of the First Trust, I know which you and I track a lot of their data, came out, I think, what was it, a couple days ago. And they just said, essentially, we're paying the price now for the massive stimulus in 2020 and 21. So even though the stock market's been hammered this year, we're basically giving back what was an astronomically unsustainable high rate of return for the stock market. You can't expect to continue to hit 20% of your averages. It just isn't normal for the stock market. So yes, this year has been awful, but we're just kind of giving back some of those gains for the last couple of years, and we're paying the price for all that stimulus. And we never really felt the lockdown effect, corporate profits, consumer spending. We never really felt the effect because of all the artificial stimulus.
I couldn't agree more. Everybody, and I hinted on this. If you look at the amount of debt we have as a country today, we're a heck of a lot better off than Japan, China, Europe. They have much more debt than we do. But we've ballooned our debt. We have 30 trillion of it right now. Now, the Federal Reserve can unwind about 6 trillion of it that they have on their balance sheet, and that's going to take a couple of years. So we really have 24 trillion, I would argue. But that's quadruple where we were just for a few years ago. And what happens is every time the government prints more debt, it makes the dollar worth less, and it inflates the price of everything, whether it's your home that's skyrocketed in value or the stock market or just stuff. So that had to fix itself. And when I talked about going back to normal earlier, normal stock market earnings mean normal stock market prices. The average rate of return on the stock market is 8%. We've been doing 14 for the last 20 years. It's too high. It's not supposed to work that way. It doesn't. Companies don't increase their value 14% every year. It doesn't make no sense. Think about if you ran a business that every year you improve it by 14%, you'd be, oh my God, it'd be the greatest company ever. So they're right. And it's because the federal government printed too much money. Now they did it to get us out of the 2001 9/11 scenario, which wasn't nearly as bad. 2008, system broke. and they needed to rescue the banking system, and they printed a bunch of money to do that. It's a terrible environment. And in hindsight, they probably did a bit too much, but we were certainly a lot better off than other countries. Europe never recovered. Japan never recovered. Japan, in 2001, their banks defaulted and they never recovered. And now in this scenario, I would argue what the Federal Reserve did initially was right. Print some money to keep us healthy and get us through the pandemic. They just went too far. So now to take the money out of the system is creating real pain. And to bore you with the detail, if only like a kind of an economics person like me, I look at the money supply, how much we have in cash, and at the velocity. If I own a company and I make something, and Jim buys it from me as a wholesaler and then sells it to Christina as an end client and puts that money back in the banking system, I borrow it and start the process all over again. How long does it take money to move through the system? Well, that movement of money had come to a crawl before the pandemic and then exploded during the pandemic because everybody had excess money. We saw the money supply, how much is in cash, really go 30% higher than history. Well, when it goes back to normal and things slow down again, inflation comes down, earnings come down, and asset prices come down. And that's the pain we're feeling right now. So this is an opportunity. This is when you want to be a buyer of stocks. You want to be a buyer of bonds. You want to get your money out of cash and go into the market because things are finally cheap. But the process of getting here was painful because the federal government did too much.
I read, Phil, in a news article, no one buys a newspaper, it's all on the phone, right? So I'm reading this article from, a big publication, and they were highlighting the mutual fund. If you own a mutual fund, you may not only have your mutual fund go down in value significantly this year, but also get stuck with a nasty tax bill, because they were saying the amount of money that's flowing out of mutual funds into ETFs, and that's where they're seeing the movement go, causes a redemption where they have to start selling stocks, right, to pay the people who want their money out of there. Is this a transient thing? So like the people watching this, if they say, wow, I'm going to get, they get a nasty tax bill from their mutual fund that's gone down in value. I mean, any thoughts on that? It's a
great point.
Yeah.
So Jim is referencing an article in this past weekend Wall Street Journal. If you want one thing to read to stay abreast of markets, my favorite publication is the Journal. And if you don't want to read it every day, read the weekend version. Jim's credit. That's the best one. It encompasses a lot of different stuff, but it keeps you aware of what's happening in economics. Politics aside, it's excellent. And one of the articles in there was called "A Tax Bill on Top of a Mutual Fund Loss." So where the mutual fund works is that we all, let's say we all three of us are invested in a mutual fund. We all are mutual owners of the fund. But I decide I don't want to be a mutual anymore. So I go to sell. So the fund has to raise cash to let me out. Give me my money, let me go. When it does that, it sells securities. So in a year like this, when the fund is down and it's selling securities, what happens is it's got to give me my money back because I'm allowed to get it back. I no longer want to be mutually owned. But by selling securities in a down market, not only did you lose in principal, the fund is down, but I may have had long-term capital gains in that fund from years of appreciation. So now, if you're Jim and Christina, who still own and I don't get a capital gain bill because I left before they issued the year-end capital gain statement, and you two do. So you get stuck holding the bag of, I own the fund and I get a capital gain bill. It doesn't happen very often because we have more. For every down market, we have 3 up markets over year. But when it does happen, it's a double whammy and it's painful. So what you're seeing is sort of a transition over to ETFs, exchange traded funds. And Christina and I and Jim use a lot of those. By the way, sometimes mutual funds are still great. There's certain asset classes where mutual funds are there. You can do a lot more eccentric things in a mutual fund. So there's times it's worth that risk. But you're seeing a lot of folks leaving the mutual fund world and going to the exchange traded fund world because it's not mutually owned. 3 of us don't own it. It simply represents an exchange. So when I'm buying and selling, I have no individual capital gain distributions because I'm not a mutual owner. I'm an individual owner. The only capital gain I would have is if my price appreciated while I own it or depreciated. So in the world where we all grew up with mutual funds, and today there's over $5 trillion in bond mutual funds. There was nothing. There was a $500 billion before this. There's now $1.5 trillion in bond ETFs. And around $4 trillion in bond mutual funds have given up about $1 trillion. It's an interesting conversation. As an active manager, someone who works with you all, part of our job is to mitigate capital gain. So I'll give you an example. One of the funds that we own with you all that was about to issue a very big capital gain, just like Jim described, we sold it. It was underperforming. We sold it before the capital gain distribution. And we bought a different one that was performing better and already had issued its capital gain distribution. For you, the investors, it cost you zero. There's no cost for us buying and selling any funds. And then more importantly, we avoided that impact of capital gain. So us as your manager, we keep an eye on this stuff. And that there's times where we can accept it. If we have a fund that's performing exceptionally in a down market, okay, we got to deal with that. But maybe we could sell something else at a loss to counterbalance it. So being active in cost management, gain management, tax management is really important. But you're right. There is a shift to using more ETFs that in certain asset classes make more sense because they're less capital gain impactful.
So Phil, I have a question, and if anyone has questions, feel free to type them in. We'll take questions for a few more minutes here. But I do have a question on recession, because I know you hit about it a lot. Obviously, this doesn't look like a normal recession. There was a lot of question, did we have 2 negative quarters of GDP? What's the definition of a recession? Which the National Bureau of Economics and Research, the NBER, is who defines and declares if we had a recession, and they always do it in arrears. But with the fear out there, even if we don't necessarily have a huge rise in unemployment, but we do have some sort of a recession, what do you do? Do you just go? I mean, a lot of times people are fearful. They go, how do we hedge if we do have a recession?
It's a fun question. Well, first of all, a lot of people say, yeah, let's go to cash. And we know there's no way to go to cash. If you and for fun, I don't normally talk about it because it's a little goofy, but if you look at the last 20 years and you look at $10,000 invested 20 years ago, it would have grown to 45,000 in that time period. You missed the 10 best days of being in the market by trying to time the market by going to cash. That number gets cut in half. I have never figured out how to use cash as an asset class. I don't know how to do it unless I can't time the market. There's no crystal ball. But there are things you can do in times of great volatility to limit loss. So one way is to own dividend-paying stocks. Dividend-paying stocks represent historically 42% of the total return of the S&P and 72% during times of higher inflation. Why? Because the dividends helps. If I have a portfolio worth $100 and it goes down by 10%, so it's worth $90, but I'm getting $2 a year in annual dividends, 2%. Why I'm worth $92, while the person who didn't get dividends is worth 90. That's why dividends are so popular. The dividend income makes me lose less. I get paid to wait out the volatility. So in your portfolios, you notice we've overweighted dividend-paying stocks to wait through this volatility. And then the other one is put things in the portfolio that hedge risk. So in other words, can I buy something that will protect and participate, protect my portfolio, but still be a part of the markets? One of the things we use is a hedge product. So the worst I can ever lose, as long as the market doesn't continue to go down quarter after quarter, but the worst I can generally lose per quarter is 5%. It limits loss by having options in the fund. Now, conversely, if the market was up 17%, we'd probably only be up 8%. So for us, the way to use that kind of cheesy golf analogy is we stay in the middle of the fairway. We're not going to hit something into the rough or the sand by buying into a stock or a fund that's going to completely get the loss or the gain of the stock market. But it's a way for us to limit loss, so we're protecting, but we still participate by being in a fund that will do well in markets up and down. That's how we survive in a recessionary world. We're also active. The market is anticipatory. If the recession is going to end in September, the rally is going to be in March. So the market recognizes when things get overvalued or undervalued and will react for it. So before I talked about going from short duration to long duration, you might think I'm crazy. Why would I do that? And then why the Federal Reserve is still hiking interest rates? Because the bond market is already starting to signal to us that rates are going to go down. The 10-year was at 4.3%. Now it's down to 3.5. So I have to recognize that the shift is already beginning to happen and anticipate it. Doesn't mean we change the entire portfolio and take full on risk, but in measured steps, we'll add more longer bonds so we get the benefit of yields going down and prices going up.
Yep. I got 2 other questions for you. Well, one's more of a comment. I know First Trust, I think we're all in agreement here. The question is whether or not we do have a recession. And, if we do, which it's still questionable, even First Trust is saying that, it's probably going to be a mild recession, and it'd probably only be, first few months of the recession that the stocks will hit bottom. So stocks bottom fairly quickly, and the recoveries happen in the midst of the recession. So that's more of a comment. I think you and I are in agreement on that with First Trust.
Sure.
Other question, I get a lot of questions about digital currency.
Oh boy. By the way, your first one, I would say certainly there is the potential for a recession. But as I mentioned already about the consumer, I don't think it's very deep and wide, but it's a kind of recession you might not even notice. Stock market's already down 25% at one point this year, and now after today, down roughly about 16.5. So we've already given up quite a bit. Now, could we give back another 10, 15% and test the lows? Sure, but I don't see that as a scenario as long as the consumer holds on. If it doesn't hold on, this is not another 25 or 50%. Don't think of it that way. Think of it as a minor correction, adding another 5 to 10% loss. Because I'll give you a quick example. I'll try and make this fast. If I look at the price of Apple, Apple's trading right now at 142, I believe. Where are you? Yes, 142. So I think about Apple, and I know that Apple has its price of, I'm going to get that right, 136. I'm sorry, 136. So $136 a share to buy it. I also know how much Apple earns. So the price, 136, divided by how much it earns. And I look at the total earnings of the company, and I divide it two. That's something called the price to earnings ratio. If you look at historical averages, price to earnings ratios on the S&P 500 is around 16. Well, guess where we are right now? 16. What's the 5-year trailing average? 16. What's the 10-year average? 16. So we're right now back at fair prices on the broad market. Tech stocks usually trade with higher price to earning ratios around 22 to 23. Where are they right now? 22 again, 22, 23. So the stock market isn't exceptionally cheap, but it's not expensive. Another 5 to 10% correction, stocks would get really cheap. And then there's your opportunity. Now, sometimes stocks are cheap for a reason, like Europe and the emerging markets haven't done well in a long time, and they are cheaper than U.S. stocks. But with U.S. stocks now still being the best game in town and stocks being fairly valued, it makes sense to me that we're not going to go down a heck of a lot more because markets will recognize value and begin to pile in. So I wouldn't worry about a recession. To me, it'd be, even if we get one, even if it's a little deeper than mild, I don't think the stock market gets bludgeoned from it because it's already sold off quite a bit. Now, the second question about cryptocurrency. And I actually think the blockchain is brilliant. And by the way, the blockchain's been around forever. The thoughts around blockchain are quite important. That the blockchain functionally is a great way to communicate, store data, execute commerce. It's brilliant because its ability to limit hacking, if not eliminate it. Problem is the currency. I just never thought it would be an effective currency. The reason why isn't because it couldn't be. I guess if you created a good, strong market for a crypto coin that was regulated and tracked, sure, maybe there's value to it. Any limited currency would be a contra to fiat currency. In other words, gold, the reason why gold is popular is a limited supply. Whereas a fiat currency, otherwise a federal currency, like the dollar, has an unlimited supply. So one is going to have fluctuation based on how many dollars are out there. One is going to have less fluctuation. That's why crypto is popular. There's a limited supply of it, in theory at least. The problem is there's not a single damn country in the world that's ever going to give up the ability to create or redeem their own currency. Will the United States ever let Bitcoin run the capital system? Of course not. Why? Because whether it's Janet Yellen or somebody else or Jerome Powell loves the ability, the power of creating new dollars in times of stress, just like we just did. The ability to raise interest rates or lower them, control inflation and unemployment. So it'll never be a currency. Not because it couldn't be, because not a good country in the world will ever say, yeah, I'm going to give up that power and let you go do it. Not going to happen. So could it ever be a commerce tool? Maybe, but that's the SEC is going to have to come in and highly regulate it and get to where the fraud, the tax, the manipulation get out of the way. And the FTX scenario just made this, set it back 20 years.
I had another question from a client.
Hold on, the FTX is a great topic for another day because everyone's scratching their head like, how did that even happen? But anyway.
Yeah. And I had one other question that I had from a client that I needed to see if you could help answer was the China-Taiwan concern as to what if China were to invade Taiwan.
By the way, Jim, I have to say something about that. All those brilliant hedge funds that went into FTX, all those brilliant people, this is why I think it's helpful to have a personal relationship with your money manager. I mean, the guy from Citadel is not getting on the phone with you all giving a conference call. For our relationship, I would tell you if I bought it and why I bought it. I wouldn't buy it because I didn't understand it. But, you know, I think there's something to be said to having relationships that bring value. And those have some of the brilliant minds on Wall Street, and they got it completely. I think they like the way the guy dressed. That's why they gave money. I'm being dead.
I think they were using QuickBooks too or something. It's just like what?
It's mind-blowing that it got to this extent. But anyway, there's a few things that keep me up at night. And one of them is China-Taiwan. And in all seriousness, when I think about what China-Taiwan could become, the impact on the global supply chain, the potential for some sort of global war, Russia and China teaming up, and then more importantly, the relationship we have with Taiwan. We have a very strong unilateral relationship with Taiwan where we get lots of goods from them. There's a very important trade partner to us. That, to me, is the scariest thing in the markets today. It's not the Federal Reserve raising interest rates. No big deal. These things come and go. It's not whether we have too much debt. Yeah, we've got more debt, but the fact of the matter is it's costing us more to finance it now, more than triple what it was a couple of years ago. But eventually that goes back down as rates go back down. I'm not worried about COVID. That seems like to be under control, whether it's people building national antibodies or whatever. That's, to me, not the issue anymore. I'm not sure it ever really was economically, because I think it had concerns about how we handled it. But in the end, you look at what really would worry me from a geopolitical standpoint, it is China, Taiwan, not Russia, Ukraine. I think that one is, for the most part, under control. Of comments made by Putin today about us giving them the Patriot missile system were quite concerning to me. I wonder what's going to happen there. I don't know if you heard about it, but Putin is extremely angry with the United States about us giving them the most advanced anti-missile system in the world. So that's getting a little spooky because they do have a large nuclear arsenal. Those things you just can't manage against those economically. And we don't. There's nothing in the portfolio that would prevent us from getting hurt. Maybe bonds would become a safe haven, maybe the U.S. Treasury. But if a war broke out in Russia, Taiwan, that's very hard to mitigate and get away from. Sorry, I'm being brutally honest. The most scared, that is far and away the thing that keeps me up at night.
Well, anyone else that has questions will certainly be available if you want to give us a call or request a time to meet. And we did record this, so we will send a recording out to everyone that's on here and post this available on our website, and Jim as well. So this will be recorded, and the recording will be posted rather. So if you didn't catch the whole meeting, I think some people were saying they caught some of it. We'll have it out to you.
Christina, Anita wants to know what DCA is.
Oh, dollar cost averaging.
I'll let you answer that one. Good job.
Yes. Dollar cost averaging. So just getting into the market at different times is always good. Not trying to pick a time or time the market, because I think my father taught me one thing in this business is the market timer's Hall of Fame is an empty room. You got to be right twice. You got
to use that. I like that.
You got to know when to get out, and you got to know when to get back in, and you can't be right twice. So.
Well, thank you for having me on, and happy holidays, Phil. It's a pleasure to speak with you all. It really is an honor.
Phil, thank you. Enjoy your Christmas party.